There was a time when dividends were considered as the primary reason to invest in stocks. In fact, if I read some of the old texts of Ben Graham, this is what he said about dividends. He said, "The true investor will do better if he forgets about the stock market and pays attention to his dividend returns and to the operating results of his companies." So what has changed over the years, and why today do we see people not paying so much attention to the dividend yield of the company? And in fact, so much so that these days people try to sell a stock before the record date, because the stock usually corrects for dividend on the record date, and they try to buy back the same stock after the company has paid out its dividend. Why is that? In one word, the reason is tax. You see, dividends are taxed extremely heavily. First, the company pays a 25% corporate tax, and then whatever it pays out as dividend is taxed in the hands of the investor at his nominal rate of tax. So if you're in your 30% tax bracket, then dividends are taxed as high as 48%. Now that's a lot. So that raises an important question, like should you really be interested in dividends? Should you invest for dividends in the first place? So the answer to that is not a simple yes or no. Why I say that is because if you ask me, my primary purpose of investing in stocks is to look for companies that can keep increasing their earnings year on year and keep adding that to their retained earnings. As the company's reserves grow, the stock price grows over time. So if you buy something today and hold on to it for a few years, and you sell little by little in the next few years after the first year, then not only do you make a long-term capital gain, which is taxed at a more favorable rate of 12.5% and works out to be the same thing like getting dividend paid, but also that the company is increasing its reserves, so it will keep paying higher and higher dividend, whatever little dividend it pays, in addition to keeping most of it as retained earnings. But then there are a lot of companies which pay dividends, particularly utility companies, government companies, where the government owns 60, 70, even 80% in that company in some cases, and buying those companies makes sense because for the government it's the same thing. It's like taking money from one hand and giving it to the other, because what the government pays in taxation for these companies comes back to the government as taxes. So in that whole process, the retail investors do get a dividend. So you should look at, in these cases, you should look at what you're making, not so much what the company is paying out as dividends, because whatever is the dividend taxable in your hands is basically all that you should be concerned with. So talking about how you should select companies for dividends, an easy approach is to just look on Google or just ask ChatGPT companies with the highest dividend yield and just make a list and buy any 5-6 of those stocks. But there's a big risk which you run when you select companies on that basis. A few years back, I remember about 10-12 years back, everybody wanted to buy public sector banks because these banks paid very, very high dividends. And a lot of those banks don't exist now. Allahabad Bank and Syndicate Bank, they've been merged into other banks. And I remember at that time used to say, these banks are struggling so much in terms of making profit, it's unlikely that they will even exist as going concerns, let alone paying high dividends. And that's exactly what happened. In fact, I'd written an article on that. I'll try and put a link to that here if anyone is interested in reading that. So this is where the concept of dividend payout ratio comes in. DPR, or dividend payout ratio, measures what percentage of a company's earnings does the company pay out as dividend and how much does it put in its reserves. So as a thumb rule, look for companies which pay out no more than 40% of its net profit in dividends. So that means about 60% of their profit for the year they're still putting in their reserves. So this indicates that the company is not only going to be sustainable in paying higher and higher dividends, but will also increase its dividends in the years to come because it has enough money to expand its business. So a company with a 40% DPR and 15% return on equity has a sustainable growth rate, and that's what you should be looking at. So I've compiled a list of 5 stocks which I like buying for dividends, and I have all 5 of these in my portfolio. First one of these is Coal India. Why I like the stock is not only does it have a very, very high dividend yield of about 6.5% or thereabouts, but also the dividend payout ratio that I talked about is fairly low. It's about 42%. And the government has a 66% stake in this company, so you can be assured that this dividend will keep coming over time. The other good thing about this company is, dividend aside, it's a great business. Today, India produces 75% of its electricity using thermal energy. This is unlikely to change in the next 10 to 15 years. So Coal India will be my first stock which I would suggest you should buy for dividends. So stock number 2 for dividends is Chennai Petroleum Corporation Limited. This is a subsidiary of Indian Oil Corporation. It's in oil exploration, and what I like most about this company is that it has a dividend payout ratio of less than 30%. So that means the company is retaining around 70% of its earnings in reserves. The other good thing about this company is that not only does it have a dividend yield of about 8.65%, it has a very high return on equity, which is about 35 to 36% as of this year. Now keep in mind that when you look for companies in energy space, particularly oil exploration, their price earnings multiple would be a little skewed because their earnings are up and down based on where crude prices are. But be that as it may, if you look at their track record, it all sort of evens out and they keep paying this high dividend, particularly if their dividend payout ratio is low enough. So before I proceed with the next stock, there's one thing that I'd like to add. There are a lot of stocks which I like buying for dividends and growth both. So, to give you a few examples, Wipro or Infosys, right now, since they've corrected a lot in price, they're paying dividends of about 3%, 4%. Great Eastern Shipping, which has a dividend yield of about 4% right now. These are stocks which I like to hold because I believe that going forward, their prices would also appreciate. And as their dividend increases, the price at which you buy these stocks would actually be great, and at that price their dividend yield would be fairly high for you for all times to come. ITC is one of those stocks which I have truckloads of in my portfolio because my average buying price for ITC is about 226. So keep that in mind that dividend should be one aspect, but sometimes some very good growth stocks, when they're available at a cheap price, you should buy those, because not only will they pay you a very good dividend going forward, the dividends itself will keep increasing, which will increase your dividend yield from your buying price. So the third stock that I'll recommend for dividends is National Aluminium Company Limited, or NALCO. The government owns around 51% stake in this company, and this is actually one of my favorite stocks, and I've held on to it for a while now. It's available right now at a multiple of about 7.51. So again, it offers growth and has a current dividend yield of about 5%. So this is one stock that you can buy, and you can be pretty sure that the dividend yield for this stock will remain high and the company will continue to pay this dividend, because again, the dividend payout ratio for the company is 44%. It's a Navratna PSU. It's one of Asia's largest fully integrated aluminium companies. So you can be sure that this company will not only keep paying high dividend. So the fourth stock that I like for dividends is Indian Oil Corporation itself. And what I like most about this company is that between all three oil marketing companies, which is Bharat Petroleum, Hindustan Petroleum and IOC has possibly one of the best set of financials, at least if you go by this year and the last 4 quarters. Not only does it have a very low dividend payout ratio, it also has the highest dividend yield. It pays around 9% dividend at its current price. So anytime you get this stock between 100 to 140, if you can keep buying a little of this stock, I can assure you that going forward, not only will you sustain your high dividend yield, but also you could get some price appreciation, at which point you may consider selling the stock. So this is one of those curious cases where I've not really understood why this stock is being ignored by the markets, where its dividend yield is much higher than HPCL and BPCL, and also on profitability metrics, this is actually, to my mind, scores higher than the other two oil marketing companies. And my final stock for dividends is Power Trading Corporation. And why I like this stock is, I know that the sales are not growing as briskly as they should be, but it's a very futuristic business. Power trading, I think, as a business, I really like. If you look at all the power generation companies, whether it's SJVN or NHPC, they've all moved up in price over the last 3-4 years, because power as a sector has done very well. I think the next sort of subsector within power which should do well is power trading. So Not only do I like this area of business of power trading, I like PTC because it's got a current price to earnings multiple of about 9.7%. It's got a dividend yield of about 4.5%, which I believe should increase. So currently the stock is trading at about 179, 180. Look to add this stock whenever you get this at a cheaper price. Not only will you make good dividends, but there is a good chance of a very good appreciation in the stock going forward. So this was my top 5 for dividends. These are the stocks that you should buy if dividends is what you're looking at and you want to steady a stream of income from your stocks portfolio and make a good return on capital over the next few years. There's a lot of stocks which people talk about when it comes to dividends. Perfect example being Vedanta, which pays a very high dividend yield. But those are the kind of stocks, Vedanta in particular, if I take that case in point, is the kind of stock where you'd see major erosion of capital. So while you'll keep making a high dividend yield just like you do in REITs and InvITs, there will be capital erosion going forward. So if you want to take a chance with Vedanta, buy it when it's available at a cheaper price and hold on to it for dividend, sure, go ahead. But I wouldn't actually buy stocks like Vedanta because they have poor corporate governance and the dividends come at the cost of your capital being eroded.